Hey there, everyone. Welcome to Chart This with Dave Keller. I am your host, Dave Keller. It's Thursday, July 9th, 2026. We are coming to you from a beautiful summer day here in Redmond, Washington. I hope you guys are all doing well. Wherever you're tuning in from, we are streaming live on Facebook, LinkedIn, YouTube, and X. We appreciate so much those of you tuning in live. You are welcome to ask questions all during the live stream. I will do my best to take some questions through the course of the day. As a reminder, tomorrow on Friday, July 10th, we'll be doing our all mailbag episode, as we like to do on Fridays, taking a little more time answering some of the great questions we've received through the week. So get your questions in. If you're watching the show later on YouTube, just use the comments section there, and we'd love to hear from you. Hope to answer your question on the mailbag episode. Pretty good day for risk assets. I mean, hands down, technology back at the top of the leaderboard. Nice recovery, energy lagging, so a bit of a reversion, mean reversion from some of the trends that we observed here in recent days. Most of the major averages all in the green, volatility lowering as the VIX gets back below 16. A lot to be happy about. Why aren't we all just pretty comfortable about this bull market environment? There are a number of reasons why, because things still feel very precarious, because the S&P and the Nasdaq are still arguably kind of range bound and still trying to get out of that range. But the charts are pretty good. So we will take a look today, as always, at the major averages and what they did. We will spend some time going through the heat map and talking about some of the key observations today at the stock and sector level. And then we'll go through some charts that I've hand selected, including our weekly review of sentiment conditions, which we like to do on Thursday's show. All right, so here's what played out through the close. Choppy open, by the way, but the remainder of the day fairly constructive. We can see that the S&P 500 up 0.8%. We can see the Nasdaq Composite up 1.3%. The Nasdaq 100 up 1.6%. Big tech back at the top of the leaderboard. Mid caps and small caps, by the way, all did better than the S&P, both up about 1.25% versus the S&P 500 large cap up 0.8%. Volatility. I mean, the VIX just started weaker and continued weaker. It spiked up to 17. That's not true. It spiked up to 17 right out of the open, but from around 10:30 a.m. on, it was pretty low volatility. The VIX actually finished below 16, and that VIX level of 16 is a good one to remember, just because what that's basically meaning is that the S&P index options market is pricing in about a 1% daily move in the S&P. That's what a VIX of 16 would represent. So VIX below 16 basically means the market's pricing in this kind of day, kind of a 0.8% to the upside or the downside, right? I mean, technically it's not directional. It's not saying the market goes up by the amount. It just looks at the daily swings. That's why in this environment with the volatility very low, what we're looking for is a big spike in the VIX, particularly over 20, because that would tell us the options market is starting to see a higher likelihood of bigger swings. And that often would mean swings to the downside, which is where larger swings often will happen, particularly in this kind of environment. So for now, the VIX not giving any sort of red flag. So if you think about it, right, a lot of the things that had looked a little concerning in the month of June, things that started to come up with, they were like, ooh, and into the beginning of July, thinking, all right, is this the beginning of some sort of topping pattern? Even though we've pulled back off of all-time highs, volatility remains very low here. That's actually a pretty good sign. Kind of a crazy day in the fixed income markets, I would say, looking at rates. Bonds basically opened lower and traded higher through the course of the day. Rates generally drifted down. The long bond yield is still about 5%, around 5.05. 10-year yield down to around 4.54, we'll call it, and the 5-year point a little bit lower. So dollar basically flat for the day. Rates generally coming in here. Rates have been fairly choppy. By the way, if interest rates are something that you are thinking about, and to be completely 100% honest, you should all be raising your hand on that one, because I would argue rates are so central to so many things right about now. I had a really good interview with Jeff Klingelhofer of Aristotle Pacific Capital. That latest episode of the Market Misbehavior podcast actually just went live early this morning. I would encourage you to check it out on our YouTube channel, or also on all the live, the podcasting platforms, that is. Jeff is just a fantastic Fed observer. He's been a fixed income portfolio manager for many years. He knows Fed history, the dynamics of the Fed, and everything. And I was able to ask him a lot of kind of rookie questions and hopefully more thoughtful investing questions about what he, his reaction to Kevin Warsh's first meeting, how he sees the Fed playing out through the remainder of 2026 and beyond. Just rates, looking at duration, looking at credit, and he had some really thoughtful observations that I hope you can make some time to review. And I would tell you, particularly if you're not super comfortable with the fixed income markets, this is what I've always found valuable. And that the conversation I had with him is a version of a conversation I had many times when I joined Fidelity and got to go up to like the fixed income office up in New Hampshire, or go chat to the high yield portfolio managers who were down the hall from us on that same floor, and just ask them, like, what does it mean when credit spreads are really narrow? Like, why is that a good sign? Like, what does that actually mean? How do you change your positioning? And having someone like him be able to explain it, for me, those are the kind of conversations that really opened up my understanding of how different areas of the market are related, what we call intermarket analysis. So hope you can check that out, because we talked about rates among many, many other things in that interview. Looking at the commodity space, gold and silver both looking pretty good here. The gold future up 1.2% today, silver up almost 3%. Copper prices higher, so that metals area of the market, particularly precious metals, looking pretty good today. I mean, do they look good from when you take a big step back from the chart of gold? I would argue absolutely not. That is still a chart in a primary downtrend, making lower highs and lower lows. Tell you what else is pretty weak today. The energy complex. You can see crude oil down pretty good. Natural gas futures down fairly aggressively, over 6% today. Across the board, energy prices kind of weakening back out. This is after they spiked higher earlier this week on the latest headlines from the Middle East today, sort of pulling back after that initial spike higher. All right, finally, cryptocurrencies generally positive. You can see Bitcoin up 1.7%, pushing above 63,000 here during the equity trading hours. In a good short-term position. Still sort of a choppy chart as it bounced down to the upper 80s, and kind of bounced up to the mid low 60s, kind of right about there. And so look for looking for a potential breakout. Still, I think to be determined with the chart of Bitcoin, but nice to see a good update here in the last 24 hours. All right, looking at the 11 S&P sectors, technology back at the top of the leaderboard. It was actually one of, if I remember right, I think it was the second best sector yesterday, right? Energy was number one and tech was number two. But today you've got technology up 2.2%. You're going to see a lot of green on the heat map in the technology sector today. Consumer discretionary has not been at the top of the leaderboard very often, but it is up about 1.33%. The financial sector, XLF, up 1%, we'll call it. Communication services about the same. 7 of the 11 S&P sectors were up. That means 4 were down. Consumer staples, the worst performer. Energy also down. Those were both down about 1.4%. Utilities down about 0.5%, while healthcare was flat. So some of the defensive sectors at the bottom of the list, also the energy sector, given the weakness in crude oil prices, natural gas prices, et cetera. The big news today, I would say, on a sector basis, technology at the top, of course, consumer discretionary and financials both having pretty good days, worth noting as well. Breadth, pretty good. Breadth was kind of a disaster yesterday. I hadn't seen breadth as negative as we saw yesterday for quite some time. But today, back to more of what we've generally been seeing here in the last month. 61% of the New York Stock Exchange listings were up compared to 36% down. S&P 500, 60% up, 40% down. Small cap index, a little bit better. Mid cap had the best breadth, about a 3-to-1 ratio, 75% up to 25% down. Looking at the Morningstar style boxes, you can see that mid cap growth was the best place to be today, up 1.7%. General observations, I mean, honestly, not much of a theme here, to be totally honest with you. Growth over value worked in like mid cap and small cap, but didn't, large cap and mid cap, but small caps are pretty much very consistent across cap tiers. I think this was more, certainly in the large cap space and in the mid cap space, growth outperforming value. Finally, Dave's Dirty Dozen, these leading stocks and ETFs in the growth space. Meta, while still not a great chart, I would argue, up almost 5% today, and that's worth noting. Micron, which has been in pullback mode, along with SanDisk and other kind of similar names in the semiconductor space, up 4.5%. Broadcom also bouncing higher, up about 3.2%. Broadcom and Nvidia, of course, two of the names also in semiconductors, but different businesses, of course, from things like Micron, have been struggling, but bouncing off of support for now. Tesla also up over 3%. Tesla's been having a tough go of it as of late. Only two of these names were down. Nvidia still not getting a lot of love for now, still holding support right at that 200-day moving average. Alphabet also down 0.8%. I grabbed the chart of Alphabet to share with you because we haven't looked at it a ton recently, but I did want to highlight just some of the recent patterns there. All right, we are going to continue on looking at the heat map. We're live streaming on Facebook, LinkedIn, YouTube, and X. Thank you guys so much, those of you tuning in live. Always a pleasure to look at charts with all of you. Welcome your questions and your comments as always. I did see a question speculating about where I was located. Yeah, I'm right in downtown Redmond at the Stock Charts office. Was doing some things here, so it's pretty awesome to be able to jump in the studio here when I need to do the show. So thanks, of course, to my Stock Charts friends and former colleagues for being so generous with letting me use this space when I need to. And I see some other comments as well. We'll save for a little later in the show, but keep them coming. And again, if you're watching the show later on YouTube, not watching it live, thanks for checking it out. Feel free to share it with a couple thousand of your friends. That would help. But also use the comments section for questions. I've gotten so many great questions from you guys over time, and would love to feature your question on our show tomorrow. All right, looking at the heat map, I mean, pretty good day, depending on the sectors that you're looking at, right? So particularly in the upper left, you've got the technology sector. While Nvidia was not good, while Microsoft was basically flat for the day, a lot of other things had really, really good up days. As I mentioned, the volatility is pretty significant right now in the technology sector. So a lot of these names like SanDisk and many others, Western Digital, had these ridiculously long and aggressive uptrends. I mean, these things essentially went vertical for months. And then you started to see a number of them pull back. And those pullbacks can be 8 to 10% one-day moves. And that still doesn't even take away from much of the uptrend and all the gains that it experienced up until that point. So up days are big, down days are big. These are just big, huge percentage swings. So I would say taking a shot at anything in the technology sector, particularly in the semiconductor space, in the software space, you just have to recognize that volatility is going to be part of that story for the foreseeable future. I don't see that changing anytime soon. Having said that, a lot of these names looking pretty good, so it's probably better to focus on the names that did not participate. Palantir still not a great chart. I would argue that chart is still more going down than going up. IBM has been the definition of volatility in the last 6 weeks, continues to have these very violent swings. We had a nice push above 300 yesterday, but a rotation below yesterday. Salesforce.com also weakening. So some of those charts, obviously some of the weaker charts, particularly Salesforce is one of the software names that's just not been a good chart for too long. But the strength is elsewhere, and certainly the semiconductor space. And really, we have to remember semiconductors is actually more and more a differentiated group of chip makers, of storage names, of memory names, of the producers versus the consumers, the distributors. I mean, there's all these different pockets of the semiconductor space now, but generally that group continues to do quite well here, and more of that today. All right, outside of tech, what's going on? I would say the energy sector, of course, pulling back here. A number of these charts we've been discussing recently because charts like Valero and MPC stand out as pretty strong charts. And I think we showed Valero on the show yesterday. Those are companies that actually can do well when crude oil prices are weaker. Many of these are going to be tied more highly positively correlated to the price of crude oil. So when crude oil is going down, like you saw today, a lot of these companies whose job it is to pull oil out of the ground and get it somewhere are going to struggle a little bit. So it's the ones that can benefit from lower oil prices that are doing pretty well. Otherwise, this is a group that's struggling quite some time. So that's why names like Marathon Petroleum are actually continuing higher today. Charts like PSX, charts like Valero, they're all in that group that is going to do just fine when crude oil. They're just not tied to crude oil directly as much. Elsewhere, a lot of red in the consumer staples sector. I saw someone mentioned Costco, and it is indeed getting clobbered today. Now, that chart arguably has not been good for a while, right? And so today is just like the latest downward move. I see this as like an impulse move, right? Moving in the primary direction, which is down, as opposed to some big red flag today. I think the flags have been pretty clear for a while now, bouncing off of 950, rotating lower. I did grab that chart to look at a little bit further, but there are a number of charts in the consumer staples sector that really do not look good. To be honest with you, there are very few charts in the consumer staples sector that I would argue look incredibly great, because most of these have just been struggling for quite some time across the different groups in here. I mean, Kraft Heinz is one of them. I mean, again, I know that there wasn't a question on like, does anything in consumer staples look good? I mean, there are some random names. There are some names that have been stronger than average. Kraft Heinz is one of those that kind of stands out. I mean, this is just in a very different phase than others. This is a name that just relatively recently got back above the 200-day, making higher highs, pulling back today, but it's making a higher high in the last couple of days. So charts like that certainly seem more constructive than average. But for every one Kraft Heinz, there's a bunch of names that just really look, have been deteriorating for quite some time. I guess the other observation would be not a ton of follow through in some of the areas where we'd seen strength more recently. We've been focusing on some opportunities in the healthcare sector. There's actually a pretty mixed day today. In the financial sector, actually some pretty good charts in here that are looking better and better. And names like JPM, BAC, Morgan Stanley, Goldman Sachs, a lot of these have been a little choppy here in the last 6 weeks, but generally trending higher. And I still think most of those are pretty strong charts to be followed. I think that's probably it here on the heat map today. Quite a few movements we can talk about, but I grabbed a lot of charts, and I often don't make enough time for charts, and I want to make sure I don't make that mistake today. Before we continue on, I do want to give a shout out to one of our partners, Seeking Alpha. I want to thank them so much for supporting Market Misbehavior. They are actually running a special for my viewers. You can get 10% off a new account at marketmisbehavior.com/seeking alpha. By the way, they have a special virtual event coming up next week on July 14th. Top stocks for the second half of 2026. Steve Kress, who runs their quant team, is going to be presenting that session, I think, with some other special guests. He's actually coming on our podcast later this month, where we'll be able to talk about alpha picks and their quant model and their approach. But you can sign up today at marketmisbehavior.com/seeking alpha. Get access to all their premium benefits, but also that virtual event and the companion article coming out next week. It's for members only, so make sure you check it out. And thanks again, my friends at Seeking Alpha, for supporting Market Misbehavior. All right, looking at the daily chart of the S&P 500, pretty good reaction move today. You know, what we've talked about on the chart of the S&P recently is the fact that we've been in this, sideways pattern for quite some time. And a couple of days ago, this was actually Monday's session, we closed above this coil pattern. And then Tuesday, we closed back to the pattern. Yesterday, Wednesday, we traded lower, and, mid-morning, late morning Eastern time, I'm thinking, ooh, this could, we could just be headed right back to the lower end of the boundary. But as we discussed on yesterday's show, you call this a hammer candle, right? We close back at the highs of the day. So, we open, we trade lower, but by the end of the day, lots of accumulation. And so we get a nice follow through move to the upside. That follows what that hammer candle should represent. That should represent next 1 to 3 bars are more likely higher. And we certainly saw that today. So now the problem is we're bumping right into Monday's high, which is right around 75.50, and we sort of traded right up to that point before closing a little bit below there. So follow through day on Friday, getting above today's close, I think would be pretty encouraging. Great way to go into the weekend. We've got Q2 earnings starting up pretty soon here over the next couple of weeks. We're going to be looking at a lot of earnings names. We haven't had earnings now for a little while, but we're going to be getting into the meat of it. This could be a pivotal earnings season where companies are addressing, the AI cycle, addressing some of the market volatility, addressing inflationary pressures, addressing interest rates, addressing whatever else comes up in these discussions. But this could be an important earnings season. It will be interesting to see how the S&P is set up going into there. For now, nice one-day break out of that pattern, similar to what we saw on Monday. Do we get a follow through tomorrow? Does the RSI push above 60? That would be another sort of shift in momentum that I've not seen yet that I would really like to see. The same chart of the Nasdaq 100, we actually showed this on the show yesterday because on Tuesday we had closed below the lower end of that pattern. We closed yesterday right back to the pattern, and we compared that to the chart of the S&P, and sure enough, today we're actually trading right back into the pattern. So the Nasdaq 100 back into that neutral position, the RSI just kind of hovering right around 50. So, I would say the Nasdaq 100 at best is a choppy sideways chart over the last 6 weeks, still waiting for a meaningful breakout. Now, while we're hanging out just waiting for a meaningful breakout, we can look at breadth conditions. In the bottom panel, that's that same chart of the QQQ. In the top panel, that is the bullish percent index on the Nasdaq 100. The bullish percent index, of course, is a market breadth indicator based on point and figure charts, basically out of a group of stocks, in this case, the Nasdaq 100, what percent of them are showing a bullish point and figure configuration. Note how the bullish percent index settled into its own kind of coil pattern here over the last 4 weeks, while the Nasdaq 100 itself has been sideways. So while the Nasdaq's in the middle of its pattern, look at how the bullish percent index is already breaking out. And that mirrors what we've seen like with the S&P 500 and the advanced decline lines, the S&P in a coil pattern, but then the 80 lines kind of breaking out. And so we continue to see signs that breadth remains quite strong relative to price action. By the way, we do have a live stream scheduled for later this month. Got a couple events coming up later this month. We're going to have a webcast. That might be next week, 2 weeks out. I forget, 2 weeks out, I want to say. We're going to be doing a webcast the week after that. We're going to be doing a live stream with portfolio managers at Tamarisk Capital Management. We had a really good live stream with them last month. We're going to talk more about some of the breadth conditions. I think it's going to be really helpful given the fact that there's a bit of a disconnect here still between breadth and price on a number of different metrics that we'll talk about. Sticking with this breadth theme, the McClellan Oscillator did break below zero yesterday. This is not updated through today's close just yet. I wouldn't be surprised if it kind of pops back up today, given the fact that the breadth data was a little stronger than it was. Yesterday it was pretty negative, but big rotation lower. The McClellan Oscillator did get below zero. That's not necessarily the end of the world, but usually when we're in an uptrend phase and the McClellan Oscillator dips below zero, that probably means we're in some sort of pullback type of move. We don't really have much of a pullback right now to speak of. So, excuse me, interesting to see that the McClellan Oscillator is rotating a bit lower. Chaikin money flow, which looks at volume, actually turned positive here this week. The Chaikin money flow has been below zero for the last couple of weeks, kind of started mid-June. Here this week, we're actually seeing it rotate back above zero. That is often a really good sign because what that means is you're starting to see signs of accumulation as defined by that particular indicator. So we'll keep an eye on that one. That's basically suggesting that we're getting a bit of accumulation over the last month, and that could be enough to push the indexes a bit higher. All right, checking in on sentiment, we're going to look at the AAII survey. That's a survey of individual investors. And then the name exposure index, which is a survey of money managers. We'll start with the individual investors, which is the AAII survey. Bulls and bears almost dead even today. 36% bulls, 37% bears. That's pretty much a zero. You can see that the spread between the two is minimal. And basically you have an even number. So the sentiment is actually not at an extreme. This one, an indicator like this, I think the signal is when we're at extremes, when there's just way too many bulls or way too many bears. Right now, we've got kind of a healthy amount of both. So the fact that this sentiment reading is indicator, I think tracks pretty well, given the fact that the S&P has been essentially sideways for the last 6 weeks. The name exposure index is at 83% last week. It was around 85%, so a bit of a slight downtick there. That's a survey of money managers asking them their positioning in the, with equities, right? So you could be 100%, even 200% long. You could be 100% short. You could be somewhere in the middle. The average right now is 83%, which is, to be honest with you, that is, almost I would argue probably the average reading in this indicator over many, many, many years. It's probably around 75, 80%. So we're a little bit above average, but really sort of right down the fairway in terms of average positioning. So no real extremes in the sentiment indicators. We'll keep reflecting on that as we get more data in the weeks to come. But for now, pretty neutral. All right, crude oil we talked about on yesterday's show because it had traded above the 200-day moving average but closed back below it today. We complete that. That's right, bearish engulfing pattern with a higher open today but a lower close. So we have a bearish engulfing pattern at the 200-day moving average. That implies the next 1 to 3 bars more likely lower on the chart of crude oil. Again, headlines aside, just looking at the charts, I would say, getting above the 200-day, following through above there, that would be a bit of a shift. We obviously are not getting that today. I think following through in crude oil above $80 a barrel is a real meaningful level. I would argue that there's plenty of people that can kind of ignore oil prices down here, but it gets above $80 a barrel. I think that's where it starts to be an issue, or you have to think that it may be a potential issue. For now, this bearish engulfing pattern suggests to us on the tactical time frame, maybe we pull back a little bit to the upper 60s and reset. We'll have to see. Did want to focus for a moment on the relative performance of the 4 defensive sectors from the top. We have utilities, we have healthcare, we have consumer staples, we have real estate. What's interesting here, these are the relative performance lines, right? So if one of those lines is going up, that means the sector's outperforming the S&P. If one of those lines goes down, we're underperforming the S&P. Interesting to note that all of these defensive sectors so far in the month of July generally kind of hooking lower a little bit. Healthcare is actually in line with the market so far in July, but you can see the rest of these kind of pushing lower a little bit from late June. And this is an important chart to watch because one of the things we noted in June was how all these relative lines started to go higher, right? And relative lines going higher suggests that institutions are rotating to more defensive positions. There's a lot of money managers with big funds that have to stay fully invested. They can't sell stocks. They have to own stocks. So what do you do if you're concerned about market instability, about potential downside risk? You get defensive, you get low volatility, you get to higher yielding sectors like these 4 that we see here. So watching these relative lines to see if and when they turn up, pretty important. They all turned higher in June, which we saw as a concerning development. They're all rotating lower here in the last couple of weeks. So that's actually an encouraging sign that you're seeing a decrease in the relative performance of the defensive sectors. Let's see. Micron, this is just a speculation, to be clear. I am not saying that Micron is a head and shoulders top. And I will tell you, some people will look at this chart and will draw too firm of a conclusion saying, all right, this is definitely a head and shoulders top. We're making a right shoulder, and that's going to be it. We can't say that that's definitely going to happen. All I'm saying is this setup looks a lot like a lot of other head and shoulders tops that I've observed. But 2 things would need to happen to complete this pattern. Number 1, we would need to see a right shoulder that's fairly similar to the left shoulder. And that is a basic concept in pattern recognition, right? Where you think of it like a piece of paper. You split the pattern down the middle and you fold it over, and do the lines line up? So there's a symmetry between the left and the right side of a pattern like this that's pretty important in terms of defining that structure. So we would need to see the next week or so look really similar to what we saw in late May and early June. We don't know if that's going to happen yet, but that's something I'd be looking for. And if that would happen, then the neckline, which is that brown dashed line that you see, excuse me, on my chart, that would have to break. And a break below that neckline, and only then could we say that is a confirmed head and shoulders topping pattern. Coincidentally, a break below that like 890 level would get most likely below the 50-day moving average as well, meaning we're breaking that key level of support. So while Micron still looks okay, I would say, I am now starting to think, all right, is this going to be a head and shoulders pattern? I think what you want to think of it now is not, it's definitely going to be a head and shoulders top. I need to short the stock. That is not what I'm saying. Here's what I would need to see to validate a head and shoulders top, and then this is what I'm going to do about it. That is the thought process I would be having as an investor right about now. Alphabet, by the way, potentially we've got this neckline of sorts up here around 370, 372. Those are the swing highs in June, also the swing high from earlier this week. It's almost like an inverted head and shoulders potentially, forming. And whether or not you decide that that's what the pattern is, it's worth noting there's a very clear level of resistance. And if and when we break above 372, this becomes a pretty compelling chart. So how I would think of a chart like Alphabet right about now is above 372, pretty bullish because that would mean we're breaking above resistance and making a new swing high. Alphabet below 318, 320 would be fairly bearish because that would be below the last Fibonacci level and below the 200-day moving average. Those are the types of charts I decided a long time ago I probably don't want to get anywhere near, which means we're in a yellow light. We're in the middle. We're in limbo when we're between those two. So for me, there's not a lot of signal right now on the medium-term time frame until we break above 372 or until we break below like 318, 320. So that's how I would think about sort of structuring the or thinking about the structure as implied by the chart right about now. All right, just to finish off, and then I'd love to take some questions before we wrap. Bank of New York Mellon, keep finding charts in the financial sector that just look pretty good, right? I mean, these are in any environment. I feel like this is one of those kind of good charts. I always sign off. It's always a good time to own good charts. This is the kind of thing I'm looking for. Higher highs and higher lows, above upward sloping moving averages, momentum strong but not excessive, relative performance pretty good. BNY checks all the boxes, and that's not unique. There are a number of banks that look kind of like that. Philip Morris, kind of a cautionary tale. It's trying to break out resistance here around 185 to 190. That actually was first tested back in summer of last year, just over a year ago. But we retested that same peak in February of this year and also May of this year. And every one of those times we pulled back down. We even popped up to 185 about 3 weeks ago and failed. Right now, we're pushing back up to 190 and pulling back a little bit. I think a chart like this, kind of a basing pattern, really pays to be patient and wait for that push to new highs on stronger momentum. And unless that happens, I probably want to avoid it. Costco, really, I mean, there have been plenty of signs well before today that this is not a great chart. And off the top of my head, breaking below key moving averages would be one. RSI going way into the bearish range, well below 40 would be another one. The relative strength being pretty dismal for the last 3 months. All of those things happened before today's gap lower. So while today's gap lower could be a bit of a surprise if you're waking up and you check the chart, I would say the fact that the primary direction is down has been clear to me for quite some time, and hopefully for you as well, as we talk about how to apply the technical analysis toolkit. Finally, hey, Cola Wars 2026, Coke versus Pepsi. I had another good interview earlier today with Tony Galea. He's a longtime money manager, advisor, and author. He wrote a book that I read right at the beginning of my career, and it was so awesome to finally interview him for the Market Misbehavior podcast. That'll be out to you hopefully in the next day or two. A really fun interview we just did a couple hours ago. But talking to him about stock picking, which is where he focuses a lot of his attention, and I sort of was reflecting on my interview with Carter Worth from last week, where we would often look at two different charts, right? When you're analyzing a chart of Coke, when you're analyzing a chart of Pepsi, it's not just what do I think about this chart? You remember, as an equity investor, you always have a choice, right? If something doesn't look right with that particular stock, there's always some other chart that might look a little bit better. And so, thinking about not just, is this a good chart or not? Think about, here's two charts. Let me A/B them. Which one's better and why? That differentiation, right? That way that you describe with the technical toolkit, what makes this a better chart than this other one? That's where I think you learn a lot about the benefits of technical analysis and stock picking, because you really start to hone in on what are the things that make a good chart a good chart. What are the things that don't make, or that make a bad chart a bad chart? Coke versus Pepsi, great illustration. I think Coke is a fantastic chart right now. Higher highs, higher lows, above moving average support. Pepsi is arguably pretty clearly not a great chart. Lower lows, lower highs, below downward sloping moving averages, right? Think about within a particular sector, even within a group like we're seeing here, a lot of times these stocks will look very, very similar, but sometimes they really don't. And using charts to differentiate stock A from stock B is super powerful. I do that on stock charts. You can easily kind of chart multiple charts on the same one and kind of do different overlays. But a lot of, the best charting platforms kind of allow you to do that A to B analysis. And I would encourage you to think about that as you're improving your stock picking prowess using technical analysis. Don't forget the benefits of comparing one to the other. All right, let's take some questions here, and we'll see what we could do. I did see some questions which I grabbed Now I don't know where I put them. That's rough. Let's see. Oh, it was very early. Hold on. Yeah, great question early on. You asked this like right as we were getting started, and I wanted to come back to it. Is it beneficial to analyze breadth within an ETF? SOXX, that's a semiconductor, one of the semiconductor ETFs, the breadth appears to be at a major low. Yeah, thanks for suggesting that. So here's the thing, right? Can you look at breadth within a sector? You can. Could you look at breadth in something like semiconductors? Absolutely, you could. The challenge though is the smaller and smaller of the universe, the less meaningful the breadth is, right? And what I mean is, if you go further and further down, it's kind of like if you looked at breadth of like gold stocks. There's just not that many of them to make breadth really, really helpful. And they all trade in such a similar fashion. So it's like, does breadth make sense for like gold miners? I would say no. Like, I don't think you're going to get much by looking at breadth on gold. Semiconductors, I would, for a long time, say that's kind of like gold, right? They're just all too similar. One of the things that's happening, I would argue, in the year 2026 is we're starting to differentiate, right? So we've got names like, like Broadcom and Nvidia, which were some of the early leaders that have all pulled back in a pretty meaningful way, all testing their 200-day moving average. You have like the Micron, SanDisk names, strong uptrends, pulling back a little bit less of a pullback, and have had a better uptrend, but pulling back. And then you have names like LRCX and some others. Actually, it looks quite similar. I'm trying to think of another one that hasn't had as meaningful of a pullback. But I mean, just with these names that I'm showing, you can see that there are a lot of kind of different configurations. And so what I think a lot of investors are starting to recognize is that the semiconductor space it's becoming clear that it's more of a specialized, area. And then there's different parts of that kind of life cycle of, in AI, right? From the infrastructure and the companies that like make the equipment to build the AI data center, all the way to the chip makers and everyone else. So they're all very different businesses, it turns out, all tied to semiconductors and AI. So I would say, maybe it does make sense to look at breadth in semiconductors. And I probably would not have agreed with that even a year ago, because I'd be like, no, those are too similar. And it was always like Intel was very different, and then the rest were kind of the same. But now you're really starting to differentiate. So my only caution of that is, and I don't look at breadth on semiconductors. I actually made a note as I was answering your question of, I should think a little bit more about maybe some ideas of how to do that. I would say like technology sector breadth, pretty helpful, because that's a huge sector with a lot of different types of companies, and can be interesting. And I actually there are a couple ways to do that, by the way. And I had a chart list. Yeah, like this is the sector bullish percent indexes, right? So each of the S&P sectors on stock charts, they have a bullish percent index. We usually look at it for the S&P and sometimes for the Nasdaq 100, but they have these set up for the 11 sectors. And so like looking at the bullish percent index on the technology sector, pretty similar to the QQQ right now, but I think that could certainly make sense. The other way is to look at equal weighted sector indexes, right? So like within, industrials or like healthcare. Here we have the equal weighted industrial sector ETF. Here we have the cap weighted industrial sector ETF. This relative line has been going down, which means the bigger names in industrials have been outperforming the smaller names in industrials. So that's a different way of looking at breadth, seeing if the equal weighted index is doing better than the cap weighted index. That would be sort of implying stronger breadth conditions. So for sure, those are some ideas. To be honest, though, like none of those are as popular as broad market breadth. Those are certainly the most widely followed indexes, and that's why we use those most often. Another question I saw earlier, and I wanted to answer for you. Is it better to draw channel lines first by connecting tops or first by connecting bottoms? They can result in different channel lines. Doesn't matter if the stock is in an uptrend or downtrend. So the last part of your question is the answer. In an uptrend, you connect the lows. In a downtrend, you connect the highs. And the way that I was taught that was, in an uptrend, you already know that the thing's going up. So you don't need a line on the highs to confirm the fact that it's going up. Like you already see that. So in an uptrend, the trend line below the trend is what's most important because that's where the signal is, right? If we break above the upper channel line, we're still going up. Maybe that helps you identify we're at the upper end of the, of the range, but still, it's like we already know that. The lower trend line is more valuable because that is the progress that the market is making, all those higher lows. So that's the anchor, and then you make a parallel line from that. In a downtrend, you want to track the highs because that's where the signal is. That's where a reversal would be obvious. So you start with the highs and then make a parallel line to the lows. That's the best practice. And it's based off of, what you're really measuring when you're tracking, when you're developing a channel and trying to lay it out. I do see a couple of other really good questions. I'm going to take a look at some of these and hopefully maybe answer one or two of them in our mailbag episode tomorrow. By the way, if you haven't been able to ask a question yet, please go ahead and do so. You can ask questions anytime we're doing the live stream, but on our YouTube channel, just use the comment section on any of our videos. We read every comment that comes through, and we appreciate you taking the time to share your feedback with us, but especially questions that we can answer in Friday's all mailbag episode. In the meantime, I will say thank you guys all so much. Those of you tuning in live, those of you watching later on YouTube, I appreciate you. And I thank you so much for checking out some charts today with me. My name is Dave Keller with Market Misbehavior, wishing you a fantastic evening. And remember, it's always a good time to own good charts. Take good care, folks.